We're here today talking mortgages, gentlemen, and so let's consider what is one of the top conversations of mortgages today, which is, should I renew my mortgage because interest rates are so much lower?
Patrick, look, I put my working shirt on today. This is my blue collar working shirt because this is the kind of work real estate investors have to do to figure out the best way to invest in real estate. And this is a common question, right? With rates at an all-time low, should you renew early and pay the fees? Is it worth it? Keith, what do you think?
Well, I tell you, it's 60% of Canadians break their mortgage term at about 38 months. So it's not something that's uncommon, even though a lot of these people say, I'll never break my term of my mortgage. In 5 years, I'm doing it. I'm not changing. But life changes. Life happens. And 60% of us do choose to break a mortgage term at about the 38-month mark.
Now, let's just right away, because I love what you just said there, Keith. Let's address the first thing, Patrick, which is some people think that breaking a mortgage, which is the language we're using, it feels dirty. It feels bad. It feels like a faux pas. It feels like
we're Canadians. We're Canadians. Don't break the rules. We're breaking the deal.
So let's just get the edge off of that. It's very much okay, and the bank, in fact, is going to make money at this. So if it works for you, don't feel bad about having to break your mortgage and get out of it early. And I think that before we jump into the details, Keith, I know that you have a magic number. Call it like a quick little estimator to see if it's worth it or not. Where should someone even begin to think about whether or not they should break their mortgage or not?
Well, if mortgage rates are 0.3% or more mortgage rates are 0.3% less than what your current mortgage rate is, then you should at least have a conversation to find out what you could be saving if you were to make the switch. That's the starting point.
So let me just be clear. So I'm paying 2.6 right now. If the current mortgage rate is 2.4, that's only 0.2, not really enough. But if I'm paying 2.6 and I can get a mortgage at 1.95, that's like 0.65. That's definitely something to look into.
That's a good starting point. Now, the 0.2% may actually make a difference for you if you've got a property that's suffering on cash flow.
Yeah.
And your amortization, say you've had it for 7 years and your amortization is lower, the combination of increasing the amortization and the lower interest payment could be a difference in taking you from a negative or break-even cash flow to a positive cash flow situation on a property so that you can keep it longer before you get rid of it.
See, Patrick, this is the kind of thing that you have to be very sophisticated about, because if you're having a hard time getting other mortgages because you have like a property that's cash flow negative, it may be worth it to take an early renewal penalty, bring it down so it becomes cash flow positive, then you could resume your wealth plan, right? I mean, this is an opportunity, isn't it, Patrick?
It is an opportunity, and I think it is really about doing the math. And from an investor focus, when you look at 1, 2, 3, 4 doors perhaps, or numerous doors, depending on where you are, it's always about doing the math. You have to take the emotion out of it and look at it and say, first off, what's my exit strategy? How long do I intend to hold this property? How long do I intend to, and what is the cash flow of it? I mean, it's not just a decision without some math and some context in behind it. And something I want to point out here is that, even for homeowners, we talk a lot about investors, and that's really what Real Estate Investment Network is all about, hence investment network. But homeowners are also can understand that when they do the math, if they're long-term buy and hold, their long-term living conditions, it may, in fact, the penalty may be worth it for them to average down, Keith, given that there could be a significant cost savings on a month-to-month basis. So I think it's something to consider there.
Absolutely. And that's such an important thing. So for homeowners, it may be that their job situation changed and now they have a slightly lower income coming in and they need to do something to lower that payment by $100 or $200 a month even to help things better, or to consolidate some debt that they've accumulated because of a change. Like any number of reasons can fit. And for investors, if they do refinance, that penalty that they would pay is a cost of doing business. And so that actually can have some other impacts and positive impacts. Say they're a high income earner, there are some advantages tax-wise that they get because that's a cost of doing business.
Now,
sorry, go ahead, JT. What I was going to ask in this is that what are a couple of things that homeowners or investors need to know up front? Like, what's a couple of key things that they have to find out first before they even go? You use the kind of a little bit of a math, 30% or 1/3 or whatever that rule was, how you explained it. Sorry, I'm more into another thought, which is, but within the contract itself, is there something in there that they should be paying attention to? Is there what I think you referred to as a bona fide sale clause, low rate offers, different special clauses? What are some of the other things that they should know before they actually move into the conversation?
Well, it's move into the conversation no matter what you do or don't know about your mortgage, and allow the mortgage broker to help flush out that information and help you to make the decision as to whether or not you can or cannot move forward and what the potential costs of doing so will be. Everything, any payout payments have to be verified by your current lender. However, some people don't know they have a bona fide sale clause in their mortgage and what that means and what limitations go around that. Right. Some people, if they were concerned about getting the lowest rate when they got their mortgage, they may have thought that they were going with a low prepayment penalty lender, but that low prepayment penalty actually is connected to a percentage of 3% or 2.75%. And that may or may not be a factor for them in the decision or choice they're going to make with doing a refinance or a transfer or early renewal.
Now, Keith, I want to touch on, because I want to synthesize this for our listeners and our viewers. And what I mean by that is, there are specific objectives to an early renewal, to breaking a contract. What are those objectives that people need to have in mind? Like, they need to have a goal. You don't want to be breaking a mortgage for the fun of it, because it's going to be expensive in most cases. So there's got to be a very clear goal. You have to start with the end in mind. What are those ends that people can have?
Yeah, so understanding what the ultimate goal is really important. Do they want to lower their payments? Is that strictly the goal? Do they need to consolidate debt? Do they just want to reduce the cost of their interest overall? Or do they need to reposition for wealth growth? Those are really 4 key conversations and questions that I ask when I'm talking to clients about whether or not this makes sense to do for them.
Yeah. And in fact, sometimes you can achieve all 4 of those things at the same time, but go in with a particular objective. Patrick, what were you going to say there?
Well, I was just going to say, and here's the other, the objective is there for sure. And then we know, so we're working backwards from an outcome, which is I need to lower payments. Primarily I want to save some money and not have to pay interest. I want to be able to buy the principal down more. Those are some really clear initiatives to wanting to look into it deeper. And then there's a couple different things, because not all mortgages are the same. We look at, let's say, a variable rate mortgage versus a fixed rate mortgage. And those 2 styles of mortgages are often very different when it comes to penalty. So why don't you give us a kind of an overview of the difference in a variable rate mortgage penalty if you're going to renew early versus a fixed rate?
Yeah, so variable rate mortgages, or adjustable rate mortgages, as some lenders refer to them to, is always going to be 3 months interest penalty. That's the rule, and that's the way that they put them in there for variable rates. Fixed rate penalty calculations, however, will vary lender to lender, because they use either the greater of 3 months interest or an interest rate differential calculation, which is often referred to as the IRD. And big banks are the most notorious for using a discounted rate formula with that to calculate their payments, whereas monoline lenders use actual posted rates that if you go to their website, you see the actual posted rate, which is what they're currently offering. And credit unions most often are 3 months interest as well. So that's, fixed rates certainly have much more complicated calculations than variable rates. And of course, HELOCs are fully open, so there's no penalty on a HELOC.
Well, this brings up an interesting point, JG, sorry, and I want to just get to it a little bit here. which is, aside from renewal, some of the listeners to this particular Facebook Live segment actually may be in the market for a mortgage right now. They may be looking to get a mortgage or in the process of getting a mortgage. And something that you want to consider is what is in your decision making. Okay, do I go with a variable rate or do I go with a fixed rate? Oh my gosh, I can get a fixed rate for 1.99. Well, that's awesome, whatever your numbers are. But consider this. Life changes. Are you looking at this as a long term? Are you feeling confident in what you're doing in your employment? Are you feeling confident in your ability to rent out the property if you're an investor? So there's conversations that you're going to be having if you're in that mode right now where I've got to renew a mortgage today because it is up for renewal. It's such an important conversation and consideration in deciding, do I go fixed or do I go variable? Those are important conversations, they're important decisions.
They really are. And Keith, while we got you and we got the man of the hour, we got the expert here, I want to get your thoughts on this because, I have my thoughts on it. I mean, whether to go variable or go fixed on a mortgage is about as polarizing as asking if you're a Democrat or Republican, in the U.S. sometimes. So what are your thoughts, Keith? Fixed or variable, and why?
Well, I tell you what, the first question is, what's the plan with the property? That's the number one question, is what's the plan with the property? If you tell me that you are buying this property and you're planning to, say, legalize an existing suite, or you're planning to add a suite, or you're planning to add a garage, or you're planning to do renovations, then the next question is, so if you're planning to do that and it's going to increase the value, when do you think you're going to want to access capital from the property from that increased value? That's an important part, a very important question as part of the process for me with my clients that are investors, or whether even that's your own personal home actually that you do that with. Because now, if you tell me you're a fixed rate person, but you're planning to do this and you want to recapture, we probably don't want to look at doing it as a fixed rate. We probably want to do a variable rate for the initial time that you're going to do that those renovations and such, so that we can minimize the cost to you at the time that we refinance.
Yeah.
Pro, this is why, Patrick, you need a power team. You need someone who's sophisticated. You need real estate investor focused professionals on your team. Keith is that man. There's no doubt about it. Now, Keith, when it comes to saving money, one of the things that people, unless you've gone through the process, when you renew a mortgage, you don't necessarily, some people are scared, and rightfully so. Some people are scared, they got 20 left on amortization. They don't want to take it back up to 25 years. They'd rather have increased payments, pay it off faster, which is, if that's part of your plan, that's fantastic. My point is, Keith, there's a couple different levers people can pull when they're renewing. Isn't that right?
Well, yeah, when you're renewing, when you're up for renewal, you don't have to stay with your current lender. And so that's the time to be, starting, 60, 90 days out before that, that's the time to start having that conversation to find out, number one, can you qualify to move your mortgage to someone else? Number two, is there other opportunities for you to create leverage with your mortgage? For example, the Smith maneuver, and putting the Smith maneuver in place so that going forward, you can take advantage of that. Those are some important things to take into consideration when you are up for renewal and you're not sure what you want to do. Your lender, you would hope, will offer you the best rate possible, but be aware that if you had a bona fide sale clause mortgage previously, or an interest rate penalty clause previously, and all you do is renew, you are sticking yourself back in that for 5 years or whatever the length of term is that you choose.
Now, interesting. Let's talk about renewing without necessarily, early renewal. Like, let's say you want to renew your actual mortgage. One of the things, Keith, that often takes place, and not all the time, but very, very often, is typically, since you've already qualified once, they'll just renew at the going rate. And if you're okay with that rate, you may want to just renew to not kind of raise any red flags. And depending on how many deals you got going on, I've done it many times where I was maybe willing to pay a little bit of that higher rate to just renew, so I didn't get bothered with a requalify, because I had other deals pending at that time, and I didn't want the whole thing to be reevaluated. You know what I mean?
Yeah, absolutely. And that can be the case. Or your income situation has changed from where it was previously, or you've added multiple properties to your portfolio since you originally got that mortgage. And now, even if you wanted to stay with your current lender, you couldn't, because you now have more properties than they would even accept. And that could be a deal breaker for you based on that situation alone. So there are reasons why it doesn't work, but it's always worth the conversation.
Yeah.
Okay, so I got it. Okay, so let's do a bit of a kind of a, here, this is real time. So give me, what is, based on what's my best variable rate 5-year open right now? Do you know?
Variable rate 5-year open on an insured mortgage, like a high ratio insured, you're talking like 1.69%.
Okay.
On a rental property, you're talking around 2.20%.
Very interesting. Okay, so the reason I give it is because I got a scenario right now, Keith.
Yeah.
So I just had one of my banks drop an email me in, Mr. Francie, you've got these 3 mortgages renewing. We need to renew them. It's in December, but you can renew now, and we'll give you 1.99 for a 5-year fixed. And I'm going, okay, that's cool.
Yeah.
But I have to now step back and go, I'm not a fan of fixed because it gives me no flexibility. So it really bothers me to go fixed. So, but now if I can go to a variable open, for example, at 2.02, I'm looking at it going, I'm going open all day long. I'm going variable all day long because I don't think rates are going to go up. I think that I'm going to be able to call the shot before they do anyways, so I can lock down anytime. It gives me that flexibility to move. That's my decision-making process. I'm not saying it should be that for anybody else, but that's how I'm looking at it. And it just happens that email came into my inbox this morning.
Yeah, and you know, in those situations, and that's where the questions are. Do you need money from any of those properties to be able to do anything to them that you know is coming up in the next 5 years? That's number one. Number two, what is the discount, that 1.99? What is the discount that they're saying that is being used to get to that rate? Because remember, that discount is going to be used against you if something changes where you need to pay that mortgage out. That's number two, and understanding what that means. So those are critical. And then 3, the variable for 0.03%. Are you willing to take the risk of a huge penalty over 0.03%? And if you are staying on top of the market and understanding what's going on, so that if you do feel you need to lock in, you can. There's always indicators before fixed rates go up.
Yeah.
And what I'm hearing, Keith, and I've seen this before, so I just want to make it clear, like, people shouldn't guess with this stuff. And I've seen people before, specifically real estate investors, who, like, they have an idea and they think they know, and they got to not, like, oh, it's probably going to be about this much to get out of that mortgage. Man, do not take those chances, guys. Call Keith, call an expert, specifically Keith, and find out exactly what the fee is going to be. Because one little clause that you didn't read in the 17 pages of documentation could make the difference between, a $3,000 penalty or an $18,000 penalty. And that may mean all the difference in the world to you. So don't take chances.
And so for clarity on this, Keith, too, if somebody phones you, do you charge for going through this process with them, or is that getting the new mortgage, getting the new mortgage arranged for them, part of how you work the back end of fee structure? Because lots of people go.
Yeah, so I don't.
They're going to have the conversation that they're afraid they're going to get a bill for it.
Yeah, I don't charge for those what if calculation conversations. They don't, as long as the client is willing to share with me basically their mortgage statement, their current mortgage statement, so that I have access to all the information I need from that just to do the proper calculations for them.
Yeah.
I don't charge for those initial conversations. They only take maybe 15, 20 minutes. And and I don't charge for that. If I end up moving forward with them, I get compensated for that time on the back end. If we don't move forward at that time, hopefully they've built some trust and confidence from them so that when they have other conversations or other people they know, they'll say, you need to call and talk to Keith because he's got the knowledge and information that you need to make a right decision.
Beautiful. Well, Keith, appreciate your time, your expertise, your insights. Lots we went over today and lots inside it. Listen to it twice if you need to because there's lots of great information in here. So, Keith, thanks so much for your time. JG, as always, good to host a conversation like this with you.
Thanks, Keith. Have a great day.
You're welcome. Thank you, guys. I appreciate it. Have a great week.